Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Back to work. President Donald Trump signs legislation ending the longest government shutdown in U.S. history, but fully restarting federal operations may still take several days. Oil holding losses after OPEC says crude supplies have surpassed demand sooner than anticipated, with Brent falling towards $62 a barrel. And South Africa's finance minister has adopted a 3% inflation target, giving political backing to the central bank. We're live in Johannesburg later this hour. Well, it's just on 9 a.m. across the Emirates. I'm Joanna Versace, back in Dubai for some big news, I guess, overnight. A couple of hours ago, President Trump signing the funding bill that has officially ended the longest ever shutdown in U.S. history. So good news, I guess, for markets. And we've been rallying into the event in expectation of that happening. We're going to talk more about that, what that means in terms of the political situation in the U.S. and whether actually we may end up in this situation once again at the beginning of next year. But for now, though, it is risk on. We've got S&P futures leaning towards positive. We're up 0.2%, very close once again to all-time record highs. Yesterday, the Dow actually closed through 48,000 for the first time ever in history. So these markets continue to be quite buoyant, despite some of the naysayers and the doubts expressed over AI spending. We'll get to that in a moment. 10-year yield slipped a little bit yesterday, down 5 basis points or so. Today, we're up about 1.5 basis points. We've sort of been hanging in around 4.10. Attention now is obviously going to turn to the data that will start coming out once the government has fully reopened again. And, of course, what the Fed do in December with that, I would say, coin toss decision at this point, whether they end up going for an interest rate cut or not at that December meeting. Dollar yen, keeping a close eye as well, keeps inching upwards. We're very close to 155 today. Not doing a whole lot, but our colleagues in Asia are saying that we might be getting close to levels where jawboning out of the Bank of Japan may be necessary. And then Brent also continues to slip. We're basically trading at a 62 handle now, 62.65. A couple of reports came out yesterday, OPEC of interest, saying that supply had actually overtaken demand sooner than they had anticipated. But then more long-term, IEA also adjusting their forecast for when they see peak oil demand hitting. So we're going to discuss that later in the show. And then switching over, and this is a chart that I just wanted to flag on capex spending, excuse me, and the numbers are really huge there. Okay, let's check in on how markets in Asia are faring. Min Min Low is in our Hong Kong studio. Min Min.
Hey, Joanna, good to see you back. And we can see the Asian stocks are advancing moderately here. Some of the regional benchmarks reversing earlier losses. Obviously, the optimism coming through after the U.S. finally ended that shutdown. But still, a lot of questions as to exactly when and how fast the federal bureaucracy could really go back to normal, right? And there's still a bit of that fog over data as well. But certainly the weakness in some of these Asian currencies helping to lift some of the stocks as well. And you flip the board. We have been seeing dollar bid for another day, and we are seeing the yen. We were briefly touching 155 yesterday, and that got the finance minister to come out to make a verbal intervention. We are now at 154. You can see how close we are to 160. That was the level when we last saw the BOJ intervened. And I mean, it's amazing that we're still back at this level again after the BOJ had already hiked rates, after the Fed had already cut rates, and it shows you that investors are really telling the BOJ that they are not hiking rates fast enough. You add to that, Takaichi and her fiscal spending plans really is expected to increase inflation, and that means the rate differential with the US will continue to persist. But flip the ball, what else is weakening is also the Korean won. You can see we are at the weakest level since all the way back here in 2009, and it really shows you that the risk sentiment towards South Korea is also quite negative at this point amid that trade tension with the U.S., the $35 billion investment pledge that South Korea has pledged to the U.S. as well, and the BOK Governor Rhee has said that the government is willing to intervene if necessary, but he's downplaying the move so far, saying that the Korean won has been excessively sensitive to global uncertainties. Jumana.
Min Min, thank you so much for that report. Min Min Low in Hong Kong. Well, President Donald Trump has signaled legislation to end the longest government shutdown in U.S. history. The signing marks the official end to a 43-day impasse that halted food aid to millions of households, canceled thousands of flights, and forced federal workers to go unpaid for more than a month.
With my signature, the federal government will now resume normal operations, and my administration and our partners in Congress will continue our work to lower the cost of living, restore public safety, grow our economy, and make America affordable again.
For more, senior editor Derek Wallbank is with us. So, Derek, maybe just walk us through what is exactly in this funding bill and what are the chances of us being back here once again at the end of January?
Jemana, it's so good to talk with you. Look, it's a big day here in the United States. The government shutdown is over. Federal workers are going to start coming back to work on Thursday, USA time. It may take days to a week for the federal bureaucracy to really sort of get fully steamed back up again. We're going to be waiting for a couple of days to get federal workers paid. It may take a couple of days to get airlines fully back to their normal schedules. We're still waiting to see about these economic indicators that were delayed or paused during the shutdown. Most of them are expected to come, but maybe not all of them, but we're waiting to see when those are going to get put forward. So there's still a couple of questions out there, but the federal government's not really like a light switch. It doesn't just switch off and it doesn't just switch back on again. This is going to be a process that, as I say, takes probably days to a week to really start going. Now, there's a couple of things in here. You asked about the possibility we'll be back at this spot again. It's a very, very salient question. Look, there's two cliffs that everybody should be watching for. The first one is the obvious funding one. That's the near the end of January 30th. And the second one is one on Obamacare subsidies, healthcare subsidies that Democrats initiated this shutdown to try and solve. They didn't get a solution on it, and those are set to expire at the end of December. And that means that a lot of people in the millions could be looking at massive healthcare premium fights or raises just walking into a midterm election fight. That's going to be a really key line to watch.
And has there been any polling that's been released to show whether either party has come out victorious from the standoff? I mean, it is the longest U.S. shutdown in history. What do we know about how public perceptions have also evolved throughout the course of the shutdown?
Yeah, well, I would say the polling that I'm seeing is not necessarily suggesting anyone won, but it is maybe suggesting that somebody lost worse than the other. And that would be that, I think Republicans have been blamed more than Democrats in this shutdown, polls show. And indeed, we saw a little more than a week ago, with elections in Virginia, in New Jersey, in New York, California, Pennsylvania, elsewhere, Democrats overperformed up and down the ticket, won two critical governor's races. And it was all sort of centered on this issue of affordability, this issue of sort of how's the economy doing. And so I think that's a really salient thing. And a lot of the president's agenda, from tariffs to federal job cuts, all of that sort of plays a role in there. So I do think that you're going to see a lot more on the issue of affordability. And that's why I highlight that thing about healthcare, because if you see a substantial increase in healthcare costs, that does pressure people's wallets. That's a pressure to consumer spending. That's a pressure on anxiety that people feel on the economy. And that's going to be a key thing looking into the midterm elections, as well as, I think, if you're sort of, an investor out there looking at all of these potential, consumer plays and where are people going in their wallets. The greatest stat that I've seen on this, Jemana, is if you go to the town of Baltimore. I used to live there a long time ago, industrial city. They cannot keep a cheap beer in stock because people are flying to value. And so the sort of things that you'd get, for $2, you just can't get it in there. And we're seeing that start playing more and more as consumers are racing towards cheap options because they're feeling pressure.
Yeah. Yeah, I was listening to a podcast yesterday talking about that exact same thing and how people are moving away from the capsules, detergents, laundry detergent, towards powder again because you can portion them better. Just to give you another example of how people are feeling the strain. Bloomberg senior editor Derek Wallbank, thank you so much. Well, we're now joined by Chia, Global Chief Investment Officer at Bank of Singapore. Good to have you with us here in the studio, Jean. Your thoughts really on the end of the shutdown and what it means for markets.
Very interesting development now, especially ahead of the Fed's meeting in December. So remember that Fed Chair Jerome Powell described the Fed's next action as driving in a fog, and when you are driving in a fog, you drive slow. Yeah. So the question now is, as the fog lifts, are we going to see potholes or is it clear skies ahead? Yeah. So I think right now there is indication that we may not even get October data because of the lack of availability. Some of that was not collected during the shutdown. So the earliest we'll get is September data, which means that we have delayed data about the jobs as well as price situation or CPI numbers. Yeah. And that really puts the Fed in a very tricky position of how to act. I mean, our base case right now is still a cut of 25 basis points. In December, but there's always the risk now that the numbers don't quite stack up.
So U.S. earnings season is mostly behind us now. And despite the U.S. shutdown, U.S. stock markets once again are close to these all-time record highs. Does it really matter for U.S. stock markets if the Fed ends up cutting in December?
So that's very much priced in. A Fed rate cut in December is very much priced in the equity markets. But what has been very supportive, of course, has been corporate earnings. I mean, we're seeing very strong earnings growth, still revisions, still on the upside. But one thing to note is the expectations, right? You will notice that in our earnings beat, the actual rise after market is not as apparent as it used to be, and also on any disappointment, the drop is also much more dramatic. So which goes to show that there is a lot of expectations priced in the market. Yeah. So we can't rule out that should there be any surprise on the data front, we will see some stumbles in the stock market, but the structural tone is still very strong.
Yeah, right at the top of the show, I quickly went through it, but there was a chart about AI capex spending and how some of these big firms have spent over $100 billion this quarter. These numbers can't keep going up. At some point, they are going to level out. Do you think that will be a risk to the market once eventually we see less growth or no growth in capex spending?
Absolutely. So the capex number has been a big focus this season. Yeah. And you can see, as you mentioned, 100 billion and above is pretty much the norm now for the mega cap stocks. So the question now is a resource grab. It's hard to know at this stage whether one is over-investing or under-investing. But what's clear is that the hyperscalers are seeing this as a ticket to play, so to speak, right? You have to be in the game to grab the resources required to support the growth in AI. But on the other hand, because the earnings expectations have also been built up based on these capex numbers, there's great risk now of earnings surprise. And for the market, I think it's very clear that some will be winners and others will be losers. So picking the right stocks as well as keeping a very diversified exposure.
Yeah. What are you watching out for in China tech earnings week?
Very much in the radar. I think if you look at the expectations for both US versus China, I think the expectations are definitely tipped on the lower side for China. But there's where I think there's more chance for an upside surprise. From an investor point of view, we do see that global investors are looking towards North Asia, be it Japan or Korea or China, that have done extremely well as AI proxies. So it may not be the upstream players, but very much on the beneficiaries of AI. And clearly there's going to be a divergence in terms of AI development, in terms of beneficiaries. So I'm very much looking forward to the results, providing more confidence for investors, because it's now a classic situation of Chinese tech being under-owned by global investors versus US tech being over-owned by global investors.
So even though the Hang Seng is up 30% since April, you still think China tech is under-owned?
I mean, on a PE basis, I mean, if you look at Hang Seng Tech from a historical standpoint, it's still just at the average level and nowhere close to, one or two standard deviations above average like the US tech firms. Yeah. Not to say that there won't be a two-track growth story for both economies, but I think we'll just exercise caution on the AI front in the US, being very selective, concentrating on quality players, versus China, where we think we're still in the early innings of the AI revolution.
Yeah, Jean, so good to chat to you. Thank you so much. That was Jean Chia, Global Chief Investment Officer at Bank of Singapore. Well, coming up, early results show the coalition of Iraq's Prime Minister Mohammed Chia al-Sudani has won the parliamentary election. More later this hour. This is Bloomberg. Democrats are again pressing President Trump on his ties to convicted sex trafficker Jeffrey Epstein, highlighting emails that suggest the president knew of Epstein's activities. A congressional committee released 20,000 pages of documents, including emails that appear to allege that Trump spent hours in a house with one of Epstein's victims. Trump posted on Truth Social that Democrats are trying to bring up what he calls a hoax to deflect from the government shutdown. Meanwhile, House Speaker Mike Johnson says a vote will happen next week on legislation to compel the Justice Department to release files on Epstein. Russian President Vladimir Putin has signed an order allowing Citigroup to sell its bank in the country. The order says Renaissance Capital will buy the unit, but gave no other details about the sale. Firms including Goldman Sachs, Natixis, and ING also agreed to sell their Russian operations earlier this year. President Trump has written to Israeli President Isaac Herzog and urged him to legally pardon Prime Minister Benjamin Netanyahu. Netanyahu is facing charges of bribery, fraud, and breach of trust in Israel. While the U.S. president has previously called for Netanyahu to be pardoned, including while speaking to the Israeli parliament last month, this is the first known letter he sent to Herzog on the issue. And United Nations nuclear inspectors say they are seriously concerned about the status of Iran's inventory of near bomb-grade uranium. Iran continues to deny the International Atomic Energy Agency, the IAEA, access to sites bombed several months ago by the U.S. and Israel. While satellite images show Israeli and U.S. attacks destroyed much of Iran's surface-level nuclear activity, they also roll back decades of access by UN inspectors to Tehran's vast atomic complex. And coming up, oil under pressure with the prospect of a supply glut likely weighing on prices in the near term. We speak to Carole Nakhle, Crystol Energy CEO, next. This is Bloomberg. OPEC has now flipped its estimate for global oil markets in the third quarter from a deficit to a surplus after U.S. production exceeded expectations. The group raised estimates for supplies outside OPEC and its allies in the period by close to 900,000 barrels a day. Joining us is Carole Nakhle, Crystol Energy CEO. Well, this really got the market moving yesterday, Carole, especially because OPEC are known for perhaps their more bullish outlooks, their more positive forecasts on demand. They now see supply-demand turning in the near term. What is the impact all of this is going to have on markets? And do you think that with Brent around $62, we've already factored in for the extra supply?
Well, I feel like it's getting like reality check. OPEC is getting through its monthly reports because for the last few years, I would say they have been the most bullish on oil demand and perhaps underestimating the supply growth from outside OPEC plus, even though themselves they put more barrels in the market. But so far, I think has it changed the market? Not really, because I feel there's a consensus that towards the end of the year, we tend to see the numbers being revised, being adjusted. And honestly, I did not know how OPEC was still expecting such a massive growth in demand compared to most of the consensus in the market. But now they are adjusting also to additional reality, which is the supply growth from outside OPEC plus. And to be fair to OPEC plus, they are not the only ones who tend to underestimate the growth in U.S. supply and the resilience of shale, because prices have been rather subdued, and typically you would expect shale activity to slow down. But almost every year we tend to underestimate the efficiency gains that we are seeing in North America and how producers there are becoming much more resilient to changes in prices. And as such, we continue to see this growth in supply from the US and elsewhere.
Yeah, so that's only going to continue to hit. On the flip side, you have another short-term driver, which is that the Trump administration has really come down hard on those two Russian oil producers. And I wonder whether that is one of the reasons that prices are still relatively supported, to account for the possibility of this Russian oil having to be forced to be substituted by other producers around the world.
I mean, I think prices are supported not because of what's happening in Russia. Definitely, it does have an impact. The sanctions are having an impact. But I would say it's China, the continuous buying from China to build inventories, both commercial and strategic, that have really supported prices and have put kind of floor on prices and have allowed OPEC to put more barrels in the market this year. But of course, we cannot underestimate the geopolitical impact of sanctions, especially that now they are hitting Russian activities overseas. We saw what happened with Lukoil, and they are running some of important assets. I wouldn't say the biggest assets in the world, but they are not insignificant in the market. Now, of course, the longer the sanctions stay in place, and if nothing else happens at the same time, perhaps we start to feel more of the pain in the market on the supply side. But I'm not too worried, because we have seen this coming. The Russians must have seen coming. Any operator or businesses or governments dealing with Russian companies in certain part of the world must have seen that coming. And it's not at the end of the world, because you do have, for example, companies going bankrupt, having difficulties. So we do have alternatives, and it's not going to suddenly cause a spike in prices.
Carole, I've got a couple of minutes here, but I just want to ask you about the IEA and the revised scenario of seeing consumption for oil continue to grow by 2050. What do you make of this about face from the IEA?
Well, the IEA has been under greater criticism these last few years because of the change, the shift, and a massive shift in narrative. Remember 2021 when they said no more oil and gas investment needed if we were to achieve net zero. Now they are talking about, in September, they published a report saying no, there's a need for massive oil and gas investment because of the natural decline in fields. And now they surprise everyone by talking about no, there won't be peak under current policy scenarios, not at least before 2050. And this contradicts what they said only a year ago. Now, one cannot help but wondering whether really the IEA is a fully independent source of data and forecasts and scenarios, as we would love to believe. Now, definitely, it is still standing by its line that they don't do forecasts, they do scenarios, and there is no denial then policy around the world, particularly at the White House, have changed, but there is always a certain political influence coming into its narrative, and that's what we're seeing today.
Yeah, Carole, thank you so much for your thoughts on all things short-term and long-term driving oil. Carole Nakhle, Crystol Energy CEO, thank you. Well, coming up, we're going to be discussing the new inflation target announced in South Africa's midterm budget update and what that means for the economy with Danelee Masia of Deutsche Bank. That's coming up next. This is Bloomberg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Back to work. President Donald Trump signs legislation ending the longest government shutdown in U.S. history, but fully restarting federal operations may still take several days. Oil holding losses after OPEC says crude supplies have surpassed demand sooner than anticipated, with Brent falling towards $62 a barrel. And South Africa's finance minister has adopted a 3% inflation target, giving political backing to the central bank. We are live in Johannesburg. Well, it's just gone 9:30 a.m. across the Emirates. I'm Joanna Versace in Dubai. If you're just joining us, well, the big news for the last couple of hours is President Trump has signed the funding bill that will officially end the longest U.S. shutdown in history. So that's the big news, and we are seeing a positive market reaction. S&P futures leaning towards the green, once again approaching all-time record highs. This after the Dow actually did make a record high yesterday, reaching 48,000 for the first time ever in history. U.S. earnings season behind us, and now there's going to be a lot of attention on the data that will eventually start being released in the coming weeks. 10-year yields at 4.09 today. We are up about 1.7 basis points, though we did rally about 6 basis points throughout the course of the day yesterday. Dollar yen also approaching 155, so we may be getting close to levels where Bank of Japan would want to do some jawboning at very elevated levels for the yen here versus the USD. Continues to lose ground versus the greenback, which seems to be stabilizing. And then Brent, we were just talking about that on the show, approaching $62, 62.70 is where we are right now. So another day of losses, heavy declines yesterday. It was down 4% in trading. This after that OPEC report came out. And OPEC are known to be perhaps more bullish, more optimistic on their forecast. But what they did actually forecast yesterday was that supply was going to start outpacing demand in the coming quarters. So that was a big catalyst for the sell-off. And switching over, we're going to be talking more about South Africa shortly, but I thought it would be nice to zoom out and take a look at how some of these key South African assets have been doing. And as you can see, over the course of the summer, we've seen the South African rand continue to rally versus the USD. And at the same time, the Johannesburg Stock Exchange has continued to climb. I believe we are at or very close to the all-time record highs. You can see it, that white chart. We had that little blip back in April around the tariffs announcements. But since then, it has been going from strength to strength. So very strong year for South African assets. Okay, let's check in on how markets in Asia are faring now. Min Lo is in Hong Kong. Min.
Hey, Jumana, I thought we would check in on how the currency pairs are doing today because we're seeing, of course, the continued weakness in the yen. We touched 155 yesterday, prompting the finance minister to come out with some verbal intervention against the excessive FX move. As you said, we're inching closer towards the 160 level, which was the level that the BOJ came in to intervene. So a bit of that market jitters coming through, but we continue to see a pressure on the yen, right? As we see the dollar strength with the government reopening, you have Takaichi and her fiscal spending plan that's expected to raise interest rates, which means that, investors are really sending the message that the BOJ is slow in hiking rates here. So something to keep an eye on, but the Korean won as well. We are at the levels flooding with the weakest levels since 2009 during the global financial crisis. And it just shows you the risk sentiment towards South Korea now, especially after all that trade tension with the United States. The $350 billion investment pledge, that seems to be taking some of the strength out of the won here. But flip the board, we take a look at some of the movers that we're tracking in China today, and we're seeing big sell-off in Tencent Music. Interestingly, the earnings came out actually pretty solid, meeting or beating expectations even. And Citibank, for one, is saying that this sell-off is unwarranted. Some analysts are saying that the long-term strategy is still intact, but there seems to be a bit of a risk-off sentiment here. Concerns about the increasing rivalry with ByteDance's Soda Music there, and concerns that Tencent may have to increase investment and marketing expenses. JD, SMIC, Bilibili, all reporting earnings today, but JD one to watch because Morgan Stanley is saying that winter is coming for JD.com, that this is the worst positioned stock in the e-commerce sector because of concerns that the consumer upgrading subsidies next year may not get extended, and JD.com could be vulnerable to a pullback there.
Min, thank you so much for the overview. That was Min Lo in Hong Kong. Now, the South African finance minister has adopted a 3% inflation target with a 1 percentage point tolerance band. The announcement is the centerpiece of Ina Godongwana's medium-term budget update and gives political backing to the central bank. Godongwana expects the new target to reduce the cost of living and borrowing costs and support higher long-term economic growth and job creation. The rand gained, stocks rallied, and government bond yields fell after the announcement. Joining us now is Danelee Masia, Deutsche Bank Chief Economist for Central and Eastern Europe, Middle East and Africa, and Jennifer Zabazaja, our Chief Africa Correspondent, joins us as well. Danelee, I looked at the market reaction yesterday, and bonds rallied despite the widely anticipated decision to change the inflation target to 3%. Ultimately, do you think that this is going to benefit the economy? Because short term, it means that nominal GDP is going to get a hit.
Thanks, Jumana. Yes, I think we do need to look at some of the short-term costs that are associated with dropping the target. But luckily, we know that the long-term benefits actually offset these costs. And the long-term benefits will certainly help the economy. the way that the market is actually responding may actually put a question mark to whether we are likely to see this pressure that everyone fears coming through. Just looking at the JSE this morning and just looking at how the rand is trading, and the combination of the external environment currently is quite favorable. So it is not a set thing that a lower inflation target might actually weaken growth necessarily. It can also translate into positive gains if investor sentiment actually picks up from here and we see greater buy-in into this recovery. Then we may actually find this lower inflation target just help to magnify the gains for the equity market even further.
Danelee, let's just talk about some of the commentary that we did get from it. You said it hit all the right notes, what we heard from Enoch Gonagwana. Can you just dig into some of the details that maybe sort of speak to that comment?
So we wanted to see a consolidation plan, and we wanted to see that the 3% was not going to derail that. And secondly, we were thinking about the risk of a tolerance band. I know that sometimes that might look like there's going to be more inflation inertia in the inflation forecast. And for government, you don't want that. You want to see a clear path of lower inflation so that expenditure can migrate downwards. And interestingly, the finance minister, or at least the Treasury team's forecast, really reflects quite easily the consensus numbers that are out there with less inertia. The more important thing for us, though, was really the issuance reduction. Right. So we are in an environment now where I guess if you want to tap South Africa's bond market, there was always a concern that there's too much supply to back the little growth that comes out there from the country. And so an issuance reduction is exactly backstopping this announcement.
And potentially we will see continued growth over the next few years. Can we just talk about Lesetja Kganyago, right? Because this is something that he has called for quite some time. We just needed the official commentary from the finance minister. We have a decision next week from the SARB. What does this mean for him and potentially what he telegraphs to the market?
So what is important here is that the finance minister and the governor needs to be aligned on policy. It sends a very strong message to the business environment, which I think the Reserve Bank was most concerned about, that inflation expectations don't adjust down. And that would have been a risk had they extended this endorsement for much longer. So it's a positive signal. I think we expect a rate cut. And I think when you've got this environment that we currently are in, plus the endorsement, it's quite likely going to be a unanimous cut from the MPC members. The inflation outlook will be further cemented by the rally in the rand. And we also think that the drop in oil prices, at least the sustained low oil prices, is very good for the economy from an input cost perspective.
Danelee, you were just mentioning the rally in the rand, and in the introduction, I was talking about the run-up that we've seen in South African assets into this budget as we head towards the end of the year. Do you think this positive market sentiment is going to continue into 2026? Do you have any targets for where possibly the rand could go?
So the rand is always such an interesting currency, and who knows where it goes. But from a fundamental perspective, I think we are likely to be still one of the best sought after currencies. The market is not over-owned from a foreign perspective when we look at both equities and we look at the bond market. And more so, we think that the commodity cycle has got legs. So if anything, and we look at the fundamentals that are backstopping the recovery for South Africa, we think that the rand could actually trade quite strong. Our official view is still very much tied towards more risk that is built up in the currency. But when you look at a fundamental fair value for the rand, the fair value for the rand is sitting north of 16. So 16.5 to 17 would be your financial fair value and fundamental fair value for the currency right now.
Danelee, can we talk about more broadly where we're at in the country and as far as sentiment goes, right? It's seeming like there's quite a few bits of positive drivers, right? Is it maybe too early to say that? What sort of helps the direction in terms of positive sentiment moving forward?
So now what we need is confirmation that this recovery is backstopped by growth. And I think that is on top of most investors' minds, is that South Africa has been a sub 1% growth economy for so long. We are hearing about this reform momentum. We can see it. That's coming through in what Transnet and Eskom is telling us. But I think investors now want to see growth improving. And so from that perspective, perhaps the third quarter GDP data that's upcoming early in December will be a confirmation that we are out of this hole. Of course, the backdrop for, tariffs and the US economy spilling over into the rest of the world didn't really help the external environment. But South Africa is starting to actually see a revival internally, which I think is quite positive.
Danelee Masia, Deutsche Bank Chief Economist for Central and Eastern Europe, Middle East and Africa. Thank you so much for joining us on the show. And thanks to Jen Zawazajja, our Chief Africa Correspondent in Johannesburg. Well, coming up, early results show the coalition of Iraqi Prime Minister Mohammed Shia al-Sudani has won the parliamentary election. Details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Preliminary results show the coalition of Iraqi Prime Minister Mohammed Shia al-Sudani has won the parliamentary election. A second term for Sudani requires consensus, however, between the Shiite parties. The 55-year-old said his coalition is willing to cooperate with all political parties in Iraq to form a new government, a process that might take months of talks. Let's now bring in Ziad Dawood, Chief Emerging Markets Economist for Bloomberg Economics, and our in-house Iraqi economist as well, so probably keeping close tabs of what's been going down with these elections. Your initial read of what we got, it seems like the outgoing Prime Minister, Mr. Sudani, his bloc did get enough votes to form a majority, but not an absolute majority. So where do we go from here?
History is usually a good guide, Jumana, and history gives us two facts. First, coming first in elections does not guarantee re-election. And second, since 2014, no Prime Minister in Iraq has secured a second term. So what's going to happen next? I think the term you're going to hear most in the coming days is the largest bloc. So you have coalitions that have gained votes and seats in parliament. They have to come together to form blocs. And the largest bloc will have the first stab at forming the government. So what's going to happen? Is it possible that the current Prime Minister will be able to expand his coalition, establish the largest bloc, and have the first stab at forming the government? Yes, it is possible. Is it also possible that his competitors from other Shia parties would come together and form the largest bloc? Well, looking at the numbers, yes, it is also possible. Is it also possible that they won't be able, neither will be able to form the government and they will reach a compromise candidate with a new Prime Minister? Well, actually, it is not only is that possible, but history tells us it's probably the most likely outcome.
Okay, so interesting. So still a lot of moving parts, and all of this is going to take a couple of months to figure out. What do you say is wearing your economist hat now, the number one thing that the new government will need to focus on from an economic perspective? Is still very much reliant on oils, OPEC's second largest producer.
Yes, so if you combine politics and economics in Iraq, the elections tell you how the pie is divided in Iraq, but what determines the size of the pie is oil prices. And oil prices have been heading down over the past 2 or 3 years, and there are talks about a large supply glut next year. Now, here is a key issue for Iraq, economically and politically and socially. Every time oil prices came down, Iraq got into trouble. In 2008 and 9, the budget deficit expanded. In 2014 to 16, Iraq went to the IMF. In 2020, it devalued the currency. So the first thing that Iraq needs to deal with is dealing with lower oil prices, because that not only determines what's going to happen to the economy, but also how Iraq is going to evolve politically and socially.
Well, politically as well, let me just ask you the question, actually maybe geopolitically, what does this election result tell us about Iraq's ability to balance between very strong ties to Iran, very big Shia presence, versus increasingly close ties to the U.S. as well?
I think there are two things here. First, the balance between Iran and the U.S. does not start after the formation of the government. It's also involved in the government formation process. And that hasn't happened in the past, and it's probably going to happen now. It's not just Iran and the U.S., but also a number of regional and global powers. Obviously, the balance of power has changed over the last 2 years as Iran got weaker. The second thing, I think, Iraq has been quite pragmatic when it comes to the Iran-U.S. balance. Let's remember that the current government was appointed by a group of pro-Iran parties, including militant groups, called the Coordination Framework. And yet, Iraq has managed to largely shield itself from the escalation that took place in the region and managed to balance the relationship between the US and Iran. So they will be involved, they'll be competing, but Iraq, regardless of who forms the government, has proven itself to be pragmatic, I think, when it came to that relationship.
Ziad, thank you so much. Great to get your perspectives. Ziad Dawood, Chief Emerging Markets Economist for Bloomberg Economics. Now for a look at some of the other stories we're following. Bloomberg has learned that government-appointed officials overseeing Majid Al Futtaim Holding have discussed a range of strategic options, including a potential stake sale. The breadth of the business, which spans malls, residential communities, and supermarkets, could prove to be a hurdle to a stake sale, as buyers might not necessarily want exposure across the firm's multiple business verticals. The sprawling $19 billion conglomerate's ownership has transitioned to multiple heirs after its billionaire founder, Majid Al Futtaim, died in December 2021. Microsoft-backed AI chip startup D-Matrix has raised $275 million from new investors. The latest funding round includes names such as the Qatar Investment Authority and Singapore's EDBI and values the firm at $2 billion. D-Matrix has raised $450 million, which will be used to ramp up production and distribution of its hardware to clients, as well as to staff customer support teams. And Anthropic says it plans to spend $50 billion to build custom data centers for AI work in several U.S. locations, including Texas and New York. It's the latest expensive pledge for infrastructure to support the AI boom. The OpenAI rival says the new sites, to be developed with UK-based Fluidstack, will start coming online next year. And coming up, Aliko Dangote, Africa's richest person, plans to invest as much as $1 billion in Zimbabwe. We'll bring you the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Africa's richest person, Aliko Dangote, says he plans to invest as much as $1 billion in Zimbabwe to build cement and power plants, as well as a fuel pipeline. The Nigerian billionaire spoke to reporters after meeting Zimbabwean President Emmerson Mnangagwa in Harare. The tycoon is adding Zimbabwe to his list of investment destinations, which spans several countries across the continent, from Ethiopia to Zambia. For more, Bloomberg's Andiro Ganga joins us now from Kigali, Rwanda. Okay, Andiro, maybe walk us back to about a decade ago when Dangote tried to strike a similar deal, and back then it fell apart.
Absolutely, Jumana. This is not Dangote's first rodeo in Zimbabwe. He tried it in 2015, where he was eyeing similar investments in cement and in coal, but these talks did not materialize under the administration of then-President Robert Mugabe, and his team left quite frustrated. They said they had to contend with things like red tape, no guarantees, and also there were allegations that they were trying to shake them up to pay bribes, something that they did not ascribe to as an organization. If we just look at the guarantees and zoning on it, he was looking to invest in a coal plant, but they had fundamental differences with the government. Dangote wanted to charge cost-reflective tariffs and also charge in US dollars because of the currency problems that the country had. But the government resisted this because back then they had such a grip on tariffs and they did not allow businesses to charge in foreign currency. Another bone of contention was the fact that Dangote wanted to send some of this coal to his cement plant in Zambia, and the administration was a little bit hesitant about that. That's why that collapsed. In cement, he was planning to build a 1.5 million tons capacity annually plant, but that also did not materialize. So now that he's coming back on board, it will be very interesting to see what incentives the Zimbabwean government puts on the table, because these are also industries that other investors, including the Chinese, have come in and they're sort of doing well in.
Okay, so what's on the table this time around, and why the change of heart from Mr. Dangote?
I think the biggest thing is the change of leadership, right? A decade ago, it was President Robert Mugabe. Now it's Emmerson Mnangagwa. And when Aliko Dangote was talking to journalists, he praised President Emmerson Mnangagwa a lot. He praised the reforms. He said they were part of the economic turnaround. And to reward this new confidence, he was going to put his investment in Zimbabwe. And this is a big win, at least politically, for President Emmerson Mnangagwa, who has been a big advocate for Zimbabwe's open. They're trying to attract investment, but they've been met with hurdles, transparency, corruption. And they're haunted haunted by the ghost of hyperinflation and a currency that has not been stable. They've changed their currency 6 times. So with Dangote eyeing coal, cement and fertilizer, it's a big win fast for perception. And if they're able to ink this deal, then we could see a return of investors back in Zimbabwe.
Yeah, could be quite impactful from that perspective. Bloomberg's Andira Ganga, thank you so much. Well, if you're just dialing into the show now or tuning in right now, the big news from a couple of hours ago is that President Trump has signed the funding bill that will officially end that U.S. shutdown, the longest U.S. shutdown in history. So there had been a run-up in markets in anticipation of this, but it's finally happened now, which is good. It's going to take perhaps a couple of days for things to get fully up and running again. But good news as far as federal workers are concerned, and good news for markets. So let's just take a look at how the reaction has been for some of these key indicators. S&P futures leaning positive, up 0.2%. The Nasdaq up 0.3%. Take a look at the Dow. The reason I'm specifically mentioning this one is because we broke through 48,000 for the first time ever in cash yesterday. So again, pointing to a positive start to the trading day. And European markets also seeing a spring in their step as well. Switching over, taking a look at U.S. Treasuries, and all eyes really going to be on the data that's going to come out in the next couple of weeks as things get back to normal again. And that December meeting with only about 13 basis points of a rate cut priced in now for December, which tells you that it's not clear-cut at all whether the Fed actually do opt for an interest rate cut at their next meeting. And certainly if you listen to the language coming out of Fed policymakers, they seem to be divided on where to go from here. And finally, I just want to end you with a picture of what's happening in oil. We are seeing substantial declines. Yesterday, the complex dropped about 4% on that OPEC revised outlook and the fact that they now see supply overcoming demand in the coming months. So that's putting some downward pressure on the energy complex. Brent trading at its $62 handle. But that is it for Horizons Middle East and Africa. I'm Joanna Bersecci in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.